Hey everyone, and thanks for jumping back into the real estate verse. Today, we're going to continue our collaboration series with Jordan Wirsz. However, rather than spending most of our time talking about Bitcoin, we're actually going to focus on real estate. Jordan has a ton of experience in real estate. He lived through the financial crisis being a real estate investor himself. He's overseen over $1 billion worth of real estate transactions. He has more experience than I could hope to imagine having myself one day. Jordan, it's a pleasure to have you here, and I'm excited to jump into real estate to talk about the outlook for that market.
Ben, thank you. It's a real pleasure, and I'm excited to be here.
Now, before we jump in, I will tell everyone pause the video, go subscribe to Jordan. He's got a few hundred subscribers. He deserves a lot more than that. So make sure you subscribe to him. I will leave a link to that down in the description below and in the pinned comment. Okay, so Jordan, what we want to talk about now is an asset class that we don't really talk about on this channel, and that's real estate. And I know you are an expert in this field, in this asset class. So, what is your outlook for the real estate market? And if you could just provide some reasoning for that, more sort of a broad outlook for the next several years.
Sure. Well, my outlook at this point is a little bit bearish, and I think that there's a lot of reasons why it would serve investors to be very cautious around real estate right now. Real estate is one of the most sensitive asset classes to interest rates, and interest rates, as we all know, over the past about 6, 7 months have almost doubled. And that rate of change is actually something that we haven't seen in any recent history. And so, because real estate is not only very cyclical, but it's very sensitive to interest rate moves, I think right now is a time to be very, very, very cautious. And as I'm watching the macro backdrop unfold and the recipe of the cake, for lack of better words, start to mix together, I see the makings of a bear market to come potentially. Then that's kind of how I see it right now. There's a lot of factors there. Of course, we have the Russia-Ukraine issues. We have inflation. We have a recession that we're either in right now or very likely going to be in the coming months and quarters ahead. And so when you kind of add everything together, and I'm looking at the data on a day-to-day and week-to-week and month-to-month basis as well, and I'm starting to see the cracks being put into the foundations here of the real estate market. I think it's time to be very, very cautious, and I would say underweight real estate for certain.
Okay, now one of the questions I have when it comes to real estate is also sort of related to what we saw back in the financial crisis, because back then real estate prices came down quite a bit, and leverage unwound quite quickly. Are you looking for something like that? Do you think what could be coming would be an outright crash, or do you think it'll be sort of a longer sort of unwinding bear market?
I think the latter, not the former. So 2008 was a really unique experience, and it was a hellish experience for those of us that went through it. It was unlike anything that I think I've ever seen since. And back at that point in time, I was a real estate fund manager and investor and developer myself. And so obviously being in the epicenter of the recession was a very difficult thing to see. And I promised myself I was never going to get caught off guard by anything like that ever again. And so, as I've studied the markets and I've studied the cycles, the 2008 cycle was really precipitated by an extraordinary amount of leverage in the system, a lot of very low FICO score, high risk, high loan to value type of leverage in the market, and a lot of progression in the derivatives markets and securities markets in and around that. A lot of speculation that drove some very irresponsible lending. Today, we're in a very different type of scenario. I don't see the amount of irresponsible leverage that we saw back then. The average credit score of borrowers today who are buying homes is much, much higher than what it was back then, and the loan to values are much more reasonable. However, that doesn't mean that just because the same factors don't exist, it doesn't mean that we're not going to have another very significant drawdown. What I see the potential for, and kind of how I'm positioning myself, is I'm expecting a multi-year bear market and relatively significant correction in real estate values, somewhere certainly in the double digits, probably 20 to 25%. I do think that there is a possibility that we see higher than that, maybe in the 30 to 40% correction territory, especially in those markets that have been highly speculated and that had a lot of price appreciation over the last couple of years. And so really what we're talking about is going back to, potentially pre-COVID levels in a lot of real estate markets around the country. So I'm not thinking a crash is likely, but I do think a slow and painful grind lower is certainly in the cards. And the charts show that, the metrics show that, and I think it's pretty clear at this point.
So speaking of, the viewers of this channel certainly like to see some charts, and with Bitcoin, we know it's very cyclical. Do you see, is real estate the same type of thing? Like, is it cyclical in a maybe a similar but different way? And what does that cycle look like?
Well, that's a great question. If I may, I'll share my screen here, and I will bring up some charts that I think will be very telling to your audience. So this is a screen. This is a chart of a long-term real estate cycle. This is data that actually goes back into the late 1700s. And this chart shows real estate activity. It's not a real estate price chart. So it's important to distinguish the difference, but typically price follows activity. So when activity is very, very high, typically speaking, you're going to see record, paces of appreciation. And so this cycle is followed about an 18-year cycle period from top to top. And it's been so accurate for more than 200 years. If you look at the last three cycles, so let's go to, the 1960s, the 1980s, and the early 2000s, you can see that the cycle has actually peaked just a couple or few years after the projected peak. So the cycles have actually extended a little bit. And there's been reasons for that. I've found this really fascinating. So if you go to the, cycle that was supposed to top in and around about 2003, we had a black swan event of 9/11 happen that created, again, the necessity for some really easy monetary policy. And you'll see that event postponed the top of the real estate market about 3 years into about that 2006 time period. And ironically, the same thing happened in 2020. So if you follow this dotted dashed line, I should say, from about the 2010 bottom, and you follow it up and to the right here, you see that we really were expected to top around 2020. And interesting that correlated perfectly with COVID. And of course, everybody in the COVID crash thought, well, real estate is, the bottom's going to drop out, the real estate values are going to tank. But the exact opposite happened. And the reason why was COVID particularly made the Fed print record amounts of money. We had record easy monetary policy. We saw interest rates go to record lows. I mean, I think even at that point, we saw the 10-year go to like 30 or 35 basis points. And so we saw extreme conditions and extreme monetary policy, and something like 40% of all US dollars in existence printed in the last 24 months. And so we saw the real estate market just take off. We saw really just about every asset class, crypto included, just absolutely go to the moon. And so real estate has found itself again in a situation where the projected cycle top in and around 2020 has extended the top of that market cycle into about 2022. And that's exactly where we sit right here and right now. And the confluence of all of the macro and micro data as well is showing that we are very likely at the top, or probably maybe 6 months past the top of the real estate cycle, that 20-year real estate cycle.
And just like in 2020, I suppose the main thing that could continue to kick the can down the road, if they really wanted to, would just be to print more money. Is that sort of the way that we could potentially get out of this potential bear market that we're heading into?
That's a really good question, Ben. And I just want to compliment you for wanting to see the other side of this equation. And that's exactly right. So what could change? monetary policy is a very big driver of economic cycles, real estate cycles, and asset price cycles in general. And so here we are, either in a recession or coming into a recession, and I think the data shows that pretty clearly. The Fed is in a really, really tight spot. They either have to keep cranking on rates to get rid of inflation, or they're going to and by doing so, force us into a recession. But if we see unemployment tick up, which is the other half of the Fed mandate, they have inflation and they have full employment. And if the full employment is less full, they might have to start easing again. And depending on the degree of their easing and how that affects interest rates, we could potentially see the market cycle be much, much shorter than it has in the past. And that's something that, a lot of really smart guys have taught me over the years, is that as we go further and further into this, fiat experiment, and with central bank authorities and, all the buttons and switches and knobs that they have to push and pull, they can affect markets very rapidly in very interesting ways that in previous cycles, just weren't thought of, that you could either do that or that you could affect markets so accurately. So that is the potential. But, there's some other interesting charts here that I'd like to show that affect real estate. I don't know if you want me to jump into some of these.
Yeah, well, I was curious, like in terms of looking at this chart, do you think, I mean, like this chart, it looks like it shows it bottoming at around 2030, like, so like it bottomed in 2000, and then, or maybe in 2010, I should say, and then it had a peak just after 2020, and it ended up being maybe potentially 2022. But also, this is not a price chart, as you say, it's an activity chart. For investors that are always looking for a good deal, what do you think? How long do you think we have to wait before we start to see those good deals?
Well, I think the next 12 to 18 months is going to be a period. This is my educated forecast at this point in time, always subject to change based on relevant things changing, like the Fed's policy.
Right.
But I think the next 12 to 18 months is going to be a period of not just the cracks showing. I think we're actually going to see the separation of the bull market and the bear market in real estate. And it's going to become very clear that we're in a bear market for real estate with double-digit, percentage correction. And so, the real estate market moves very slowly in comparison to other asset classes. Like Bitcoin and Ethereum, those can move 10, 20% in a day, right? Real estate is very different. There's a life cycle of real estate transactions, and there's a seller cycle and a buyer cycle. And let me just talk about those briefly. So sellers have to come to terms with selling a home. They have to get to a point where, they start preparing their home for sale. Usually that takes a month or two. Then they list it, and that takes another month to maybe get a buyer. And then they get into escrow, and it takes maybe another month or 45 days from there to get it closed. And so in a perfect world, real estate really is like one transaction to another, about a 3 to 6 month process all in. And so real estate lags, and it moves very, very slowly. And buyers are very similar. When a buyer decides to enter the market to buy a home, typically it's not hey, I'm just going to go buy a house tomorrow. It's a process. It's deep thought, deep consideration, pre-qualifying for loan, getting things all lined up. And so real estate tends to take many months to actually see prices move. Now, there's leading indicators inside of real estate and different metrics that we can look at to kind of give us a clue as to the direction that it's likely heading. If I had to guess, I would say that when we look for tops and when we look for bottoms, we're really looking at the macro indicators in the entire market cycle. And that includes an accumulation period. And I know you talk about this on your channel as it relates to crypto quite a bit. There is this accumulation phase of real estate where you're really not measuring double-digit appreciation or depreciation percentages, but just areas of almost static activity where inventory is getting absorbed. very similar to the crypto markets. If you look at an order book of Bitcoin and you see where the sellers and the buyers balance out, and if you see a big wick down, and then all of a sudden you see that wick develop with price starting to come back up, you'll actually see absorption of the product. And that's what we need to find in real estate. And so I think 12 to 18 months from now is going to be that wick down. And I think we'll start to see some of that absorption actually take place. And that's where you find the good deals. Even though this chart says, listen, hypothetically, we see a bottom in real estate activity in 2030, I definitely wouldn't wait to 2030 to begin acquiring real estate. One of the neat things about real estate, and that makes real estate really unique, is that you can acquire assets at a disparity to present market value. There's always getting a good deal. In crypto, if you're buying Bitcoin or Ethereum, you're paying whatever the spot price is at that very, very second. In real estate, value is very subjective, and value varies on a whole lot of different things, the quality and condition of a home or a piece of commercial real estate. And so it affords you the opportunity to buy when there's blood in the water, so to speak, buy during that accumulation period and actually find deals or find opportunities in undervalued areas and undervalued neighborhoods, and also in an undervalued time.
I think that's really great advice. But one thing I want to hone in on here, and perhaps you can sort of dive into this, is like, this is a very long-term macro chart. Of course, it has no knowledge of any particular local market at any given time. But do you have any data showing, like, are there increases in, say, listings, like supply year over year? Are there anything like that? Or do you see people dropping the prices of their homes quicker than they have before? What do you see in sort of that area? Because if we see a clear trend there, it could help support this thesis.
Excellent questions, Ben. Let me bring up another chart here. This is the Redfin pending sales in all of Redfin's metro areas. And, this chart has 2019, 2020, 21, and 22 on it. And you can see that 2022 pending sales are actually sub 2021 pending sales numbers at the same time. And that's a really important metric. That is certainly showing a slowing. And if you look at the trajectory of that curve, the black line there, you can see that if it continues on this pace downwards, we're going to be not only below 2021 pending home sales numbers, but we're going to be below 2020 pending home sales. And year over year, this is about a 9.74% decrease in pending homes. And of course, that's one metric that we can look at. Another one is homes actually sold. And again, this is following the same kind of trajectory. Home sales year over year are down 9.3% in all of Redfin's metro areas where they collect data for. And what's fascinating but very ominous is that this black line is approaching and converging and very likely to cross with even 2019 data. And so the potential is, as we get further out into this year and recession takes hold, if that be the case, then we have the potential to see homes sold numbers below not just 2021, not just below 2020, but below 2019 as well. And that is certainly going to be indicative of a bear market.
Yeah, that's really interesting. And it's interesting too, because you're seeing some of this stuff come down during a period where you might otherwise expect it to go higher, because it's like I don't really know that much about real estate, admittedly. I've mainly been focused on stocks and crypto for my investing career. But one thing I do know about real estate is that you typically will see an increase in demand and whatnot around like spring and summer time frame. But we're starting to see some of these things already start to come down. Is that right? That's what it looks like.
That's right. Yeah, and it does vary. One question that I get asked a lot is the national data indicative of what's going to happen regionally? Well, real estate as an asset class Typically ebbs and flows and its cycles go nationally, and then there's nuances to stronger markets and weaker markets throughout the nation. But what I can say is that just kind of based on the data now, we should be seeing in these summer months, especially in areas like where I live here in Coeur d'Alene, Idaho. These are the summer months, and it's just magical up here. And it's a second home community for a lot of people. It's a very affluent place to live. And we're watching the numbers here in North Idaho decrease substantially from 2021, and we're getting very, very close to 2020 numbers as a whole. And that's really interesting because this is, this was in 2021 named one of the hottest real estate markets in the country. And I think we were actually on the front page of the Wall Street Journal as being one of the most overvalued markets in the country. And we're seeing the signs. One thing I learned in the 2007, 2008, 2009 timeframe is to pay attention to the signs around you. Looking at this data is really interesting, but what's more interesting is actually getting on Redfin and getting the alerts as to how many price reductions are happening and how many homes are falling out of escrow and getting put on the market again. And the numbers are actually staggering, not just here in Coeur d'Alene, which was a very inflated market, arguably, but nationwide. And I'm going to show a chart here real quick. This is the percent of active listings with price drops in all of Redfin metro areas. And if you look at this black line, I mean, it's just almost going parabolic.
That's 2022.
And this is 2022. The black line is 2022. And so we're up, percent of active listings with price drops is up 4.5%. And when you compare that number to the other lines, which is 2019, 2020, and 2021, you can see that there's a stark contrast between these two. And I don't want to chart hop too much, but here it is visualized in a slightly different way. Listings with price reductions year over year are, up just absolutely massive. And when you look back into the 2017, 2018 eras, we haven't seen anything like this rate of change in recent past. I think if this data went back towards, 2007, 2008, you would see something very, very similar to this. But this is certainly indicative of more inventory coming on the market. People are worried about where their equity is going to go, and they want to cash out sooner than later.
One thing you mentioned at the very beginning, and I kind of want to talk about this a little bit, are interest rates, because, with the Fed raising interest rates, it has certainly led us into a risk-off time, when talking about, say, with respect to like crypto and stocks. But of course, one of the effects is mortgage rates have gone up quite substantially, and it sort of begs the question, well, who are the sellers, right? I mean, because we see these charts and we can see that there's inventory, there's more inventory coming on, but it sort of also begs the question, like if I currently own a home and I have a relatively low interest rate, let's say 3% or something, because I mean, anyone who bought a home, up until recently could have gotten a really low interest rate in recent years. Who's selling the homes? Because supposedly, I mean, if they're going to go sell their home and it's their primary place of residence, they have to figure out somewhere else to live, right? So do they go buy another home? But if they do that, they have to pay the higher interest rate, or their mortgage is going to be higher. And then how does that sort of relate to people maybe with secondary homes? Some people potentially purchased secondary homes or vacation homes during the pandemic. Maybe they decided they wanted to work remotely, or their place of work allowed them to work remotely. How does that fit in with everything? Because like if I'm a homeowner and I see these prices, I'm like, well, how do I weigh my house being up X amount, but also realizing that if I sell it, I'm going to have to go get another house with a much higher mortgage?
Really great question. And you're spot on, and your thinking is very, very spot on. So let's walk through the psychology of a seller for a moment. First, we have to consider demographics, not just geographically, but also age-wise. So let's take North Idaho as a perfect example of this. There's a lot of people who owned a 2,000 square foot home built in 1980 on 10 acres that for years was worth between, let's say, 200,000 and 400,000, right? All of a sudden, COVID hits and people are cashing out of California, and they're selling 900 square foot homes on a 3,000 acre lot for $1 million or $2 million. And they're coming to North Idaho and they're going, I can have a house 2 or 3 times the size, and I can have 10 acres and I can live in all this beauty for $2 million. What a great deal. Well, some of these people that have lived in these more rural areas, like North Idaho, are cashing out in the millions, and their home prices have doubled, tripled, or quadrupled in the last few years. And for them, they're saying this is actually perfectly timely for me, because now I'm getting to an age where I want to live in a more metro area, closer to healthcare, maybe closer to the grandkids, and I can take this $2 million that I'm getting for this home and go do something productive with it, live a life. We're seeing people here in North Idaho selling and saying, we're just going to buy an RV and we're going to travel the country for 12 months until we figure out what's happening. But you're also watching the younger demographic that purchased homes in the last 5 years or so. And they have made more money in appreciation than they've maybe made at their day jobs in the last 5 years. And so they're saying, like, now is a great time to cash out. And hey, I'm going to take this 400,000, 500,000, 800,000, and I'm going to go stick it in the bank, and I'm going to rent for a period of time. And so I think we're seeing a transition where it's like people aren't just selling to rebuy, but people are selling to actually take chips off the table. And interest rates, though, on the other side of that, are really hurting buyers. I think buyers have been wanting to get into the market, and in the last 12, 18 months, it's been so competitive that literally you would go see a house, and by the time you finished your showing, it already had an offer on it from someone else. That's how hot the real estate market was, and that's kind of indicative of price bubbles. And so that's put a damper on a lot of buyers. Now, on the other side of that, there's actually some inventory on the market, and people are reducing prices. Now, interest rates have effectively doubled, but those buyers in the market are kind of grappling with the idea of affordability and stability owning a house versus renting. Economically, though, interest rates are very, very important. I think that, and I've got a chart here that I can bring up. This is a long-term chart going back into the 1970s of the 30-year fixed rate mortgage. And you can see the interest rates have continued to go down, 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 and down. But the rate of change that we have seen in the last, call it 6 months, maybe 7, 8 months, has been really extreme. And so for the last, 40 years, 50 years, we've had this cyclical, or I should call it maybe a secular bull market in real estate. And the real question to ask is that secular bull market going to turn into a multi-year, or perhaps, even as long as a decade, secular bear market? I don't necessarily think that that's the case, but I do think that interest rates have given a big shock to the real estate market here. And this is kind of a zoomed in version of that chart. And Ben, I mean, just look at this parabolic run on interest rates that we've had over the last 6, 7 months. We were at record low interest rates down in the, high 2%, and now they're 5, 6, sometimes over 6%. And those are interest rates that we haven't even seen in the last 4 years, going back to like 2018. So this rate of change has the potential to scare buyers out of the market as well.
But let's suppose that I'm a homeowner, and I decide to sell my home, and because I want to take advantage of the higher prices, or maybe it's appreciated a lot in the last few years, and I decide, what, maybe I want to do something else. Rather, maybe I either want to downsize, so that it wouldn't be nearly as expensive because I'd be facing this higher rate. But one common opinion I've seen, and I don't know if you've seen it as well, but I've seen it a lot amongst a lot of millennials, it's that they want the housing market to crash because they've been priced out, right? Like they've been
Yeah.
priced out of the type of home that their parents probably bought for, on a similar type of income. I mean, adjusted for inflation, of course, but you know, and it's sort of maybe a scary thought for a lot of people that maybe the house they grew up in, and maybe their parents had a certain job, maybe they have a very similar type of job, but they're completely priced out because everything's just gone astronomically high over the last several years. So I'm sure this sort of demographic would welcome a pullback in housing costs. But how does that? I mean, it sort of begs the question. A lot of these people that are hoping for that are probably renters, right? I mean, they've probably been renting for a while because they've just been simply maybe they don't have the down payment for a house, whatever it may be. How does renting compare to home ownership, and especially with these high interest rates? Like, how does that affect the decision between, saying, buying a house and renting?
I love your questions. I want to bring up a chart just really quick. And this is a home price index from Case Shiller. And this shows that the index at the 2007 bubble, in terms of price, median price, was at 184. That's the index level. Here in 2021, we saw the index top out at 249. And so when you talk about affordability, I mean, we've seen price appreciation such to a substantial degree that you're right. A lot of people have been priced out of the market, and a lot of millennials are hoping that they will see a price crash and actually be able to afford a home. And there's some really interesting data about renting versus owning. This is a chart from Redfin that shows the national averages of both owning a home and renting a home. And you can see that for the first time in the last 3 years, the two lines have actually crossed. Prior to basically 2022, the start of 2022, it was cheaper to own a house than it was to rent a house. And look at the vertical peak. I mean, look at that thing, just like it just turned up and never looked back. And nationally, it's about 20%, or excuse me, about 10% more expensive to own a home than it is rent a home. And so you're seeing, these people are thinking through in their minds, well, wait a second here. If we're going to replace the house that we're selling, it's going to cost us more than what we're paying now, because these people locked in mortgage rates probably years prior during a lower interest rate time period. And so, there is this dynamic that's starting to play out. But if we drill down to specific markets, you can see that the premiums to own a house are even more significant. Here's Las Vegas, for example, which was my home market for 20 years. And it's about a 20% spread. It's just since December of 2021, we've gotten about 20% more expensive than renting. And, this is not unique to just Las Vegas. We can look at Denver, Colorado. In Denver, Colorado, it's still about a 20% spread more expensive to own than to rent. There are a couple of interesting ones. Let's take a look at Anaheim. Now, Anaheim, since going back to just before COVID, the lines were pretty close to each other. And look what happened. It actually got much more expensive to own, like not just by 20%, but by a huge margin, like a third or more to own than to rent. And so, you got to ask yourself the question, well, what does this do to the housing market? What does this do to people's appetite to buy homes? Well, if we're looking at, a lot of the other markets, it was cheaper to own than it was to rent. And now we're seeing those trends reverse. Interesting. The one market that's been different is Miami. And this is kind of fun because you and I were in Miami just a few months ago at Bitcoin 2022, and we were talking about real estate and owning real estate in Miami. And you can see basically that even though this curve here on the right is starting a parabolic trajectory. It is still cheaper to own even at these interest rates than it is to rent. So that's unique to Miami.
One thing I sort of see like a recurring theme in a lot of these charts, with the exception for maybe Miami and Anaheim, is that the reason they're crossing is not because the cost to rent is going down, it's the cost to own a home is going parabolic, and then sort of intersecting the the price to rent. And it's sort of like it just makes me think. And again, I'm not a real estate expert, so I'm not at all. But it sort of just makes me think, like, how can this be sustainable? And as you said earlier, like, are we seeing those cracks start to show, right? Where like listings are up, and home price reductions are up, where people are getting a little worried about the price they've listed it at, and they're starting to push it back down. And now we're seeing the cost to own a home is now more expensive I mean, look at the I mean, like, for on the nationally, it was already over. And by the way, the cost to rent is about 2,000, right? I mean, the average is now 2,000, which isn't cheap either. So I mean, it really does beg the question, like, how is something like this sustainable for people? And I mean, I guess it just provides more evidence to the idea that a bear market in the real estate market is likely heading our way.
I don't want to get married to an idea and a narrative. And as a professional investor and asset allocator for 20 years, I have to wrap my head around the idea that I might be wrong. Mm-hmm. And so the things that can change are monetary policy, things that can change our interest rates. We can have a white swan instead of a black swan. Maybe we have something really, really great happen in the market, something totally unexpected that turns things around. But the idea that real estate is a lagging, indicator, kind of an asset, it really takes time for things to play themselves out, especially with builders and home builders. Their building cycle takes them several years to, acquire land, entitle the land, develop the land, start to build homes, put the homes under contract and sell them. And like, it's a very long process. And so you have to start looking for the cracks in the armor. Well, I can tell you that locally here in North Idaho, last year in 2021, we were literally named one of the hottest real estate markets in the country. It's a beautiful and great place to live, and people were migrating here. Like, we were in the top 3 states in the nation where people were migrating domestically to. And we saw nothing but bidding wars for 18 months. I mean, even the house that I'm in right now that we bought, we were in a bidding war to buy. And it really frustrated a lot of buyers, but the market just kind of perpetuated itself, and it just kept going and going and going. Well, now we're starting to see the opposite happen. Now we're starting to see price reductions, right? Going back to this chart, here's the Redfin data showing that year over year price reductions are up, 4.5%. And I'm getting alerts daily of homes that are coming back on the market, deals are falling out. I'm getting alerts that people are reducing prices, and even reducing prices on very reasonably priced homes. So, when we talk about like boots on the ground, like paying attention to what is going on around you, here in North Idaho last year, any home under 500,000 or 600,000 was sold like that. I mean, that's considered a cheap starter home in this area. And so those homes weren't on the market, but like a day, sometimes a matter of hours before they were scooped up. Well, now I'm getting multiple alerts saying we're having price reductions, and you're watching people, there's kind of this seller emotional and mental thing that they have to go through, especially when they've made so much money over the last several years in price appreciation. And so they're wanting to lock that profit in. And so they have this expectation that real estate prices are high, that the market's strong, and their first price reduction is typically very, very small. It's a token 5,000 or 10,000. But now I'm seeing homes in the 450 to 650,000 range, which are, lower end starter homes here in this area. And we're seeing $25,000 price reductions and sometimes multiple price reductions. It's not just one, but it's several. And you're starting to see some of those sellers become more and more desperate to lock in that profit and take that profit off the table. So those signs and the things that are happening here and the slower pace of activity, the slower pace of sales, the longer the inventory is staying on the market, those are all leading indicators that lead us to the conclusion that at least at present time, prices will be and should be on a negative trajectory going forward.
One thing I think about too is unemployment. And I mean, you talked about, either we're in a recession or we're likely headed to one within the next 12 months. And with these sky high prices in real estate, we know unemployment, there haven't really been, I think there have been some layoffs already. Even some companies, I know, I know that there have been some layoffs, but I don't think we've seen necessarily mass layoffs yet. I feel like the job market is still relatively strong at this point. I do imagine, unemployment, if unemployment were to start going higher, then that could sort of, perpetuate like this bear market idea. But then it begs the question, right? Like, what gets us back on track? I mean, like, let's suppose that, we go down for a few years and maybe it bottoms, I don't know, in the next few years sometime. What gets the real estate market back on track into, say, like the next cycle? Because again, we're investors, we're all investors here. We're always looking for, okay, how can we invest and to see our wealth ultimately grow? Um, what signs are you looking for that the market is about to start another longer term bull market into like its next cycle after this bear market? What gets us back on track?
Yeah, great question. So, okay, there's actually two questions embedded in that one question. The first question is, what signs are we going to be looking at that we're bottoming? And the second question is, what is the catalyst for the next bull market? So let me start with the first part. So we need to see absorption happen in the market. We need to see inventory levels rise and remain elevated for a period of time and watch prices stabilize. So like just in crypto, right? You tell your subscribers, don't catch a falling knife. There's no reason to try and guess when there's going to be a bottom. Let the market kind of tell you that a bottom is forming. Well, the same thing is true in real estate. So you want to be looking at rising inventories beginning to stabilize. You want to see declining prices begin to bottom out and stabilize. And then you want to see the inventory being absorbed at the same pace that it's being put on the market at. Now, I pay attention to a lot of different charts, a lot of different price metrics and leading indicators in terms of real estate. The very first chart that I showed is kind of the 30,000 foot overview of, hey, here's where the cycle is likely to play out, the tops and the bottoms. Then we drill into interest rate cycles and we drill into monetary policy from a macro point of view. And then we drill into the specific metrics. Now, we're talking a lot about residential real estate, and I flipped several hundred homes in my career, and I've been involved in residential real estate investing and development for a long time. But the greater part of my career has been in commercial real estate. And personally, I enjoy commercial real estate as much or more than residential. And the things that you look at there are actually very tied to the macro. You look at things like interest rates and how capitalization rates or cap rates are affected by the market, and tenancy delinquency, and number of tenants coming into markets, and is office stronger than retail. So there's a lot of different metrics that you can use to gauge, number one, how the economy is doing, and also gauge how much absorption of the inventory there is. And when you put all of that together, you'll see those bottoms. Now, what is the catalyst to another bull market? The catalyst is actually very close to the same narrative that a lot of us Bitcoiners talk about, which is the debasement of fiat currency. If you plot real estate values over the course of the last 70 years, really we have followed a line just based on inflation and devaluation of the US dollar. And so you want to find times where you not only come down to a mean line, but you want to go past that mean reversion line and find areas of deep value. And I think we could be approaching one of those here in the coming, 18 to 24 months, and buy undervalued assets. And then, of course, over time, as things normalize and as monetary policy eases and inflation eases, you'll see real estate rise as an asset class just in general, because our fiat dollars are decreasing in value, and it kind of follows along that same trajectory. And it's been a great hedge for many years. And you can do really amazing things in real estate if you use leverage at the right time and avoid it at the wrong times, and be in the market at the right times and be out of the market at the wrong times.
That's really interesting. Again, I'll have to have you on in the future, because when I get in there, when I get into the real estate market, I'm gonna want some data to back up my decisions. But one thing that we talk about a lot on this channel is Bitcoin. And we sort of dabble with equities as well, but it's primarily focused on Bitcoin and crypto as a whole. And one of the things that I think that we can sort of look back on, and I'm sort of speculating here, but the real estate market is very intertwined with everything else, it seems, right? Like
Yes, it
everything
is.
else. So, and we were actually talking a little bit about this a few days ago, and what happens if the real estate market, because as we said, right? I mean, it went up, as you said, it went up a lot over the last couple of years. It's starting to sort of like show some cracks, but it also goes kind of slow. The next Bitcoin halving is in 2024. And normally we see a bull market after Bitcoin's halving. And usually the bottom for Bitcoin occurs before the halving. But it begs the question, what happens to risk assets like Bitcoin if they're in the middle of a bull market when the real estate market, like the bottom falls out or something, right?
Yeah.
Does that lead us to a cycle with Bitcoin where we're unable to put in a new all-time high? Or if we do put in a new all-time high, maybe it's not so much. I mean, even this past cycle was actually about a 3x, a little more than a 3x over the prior all-time high. But even then, I mean, even if, let's say, Bitcoin bottoms at I don't know, 10K, 15K, 7, even if it's 17 and a half, like even if we've already bottomed, you could still see returns. But then it sort of begs the question, what happens, right, if the real estate
Yeah.
market falls out? Because again, I was too young to appreciate what was going on back in the dot-com crash, and then what happened. I was sort of paying attention to the to the financial crisis, but it seemed back then like risk assets were starting to do well again, and then the financial crisis occurred, and real estate dropped a ton, and it took everything with it. So, do you
Yeah.
see? I guess the question, right? The main question is, if real estate drops during the middle of a Bitcoin bull market, do you think it would affect the ROI of Bitcoin during that bull market?
Yeah, I do. Um, I will say, I mean, certainly everything in this world is correlated, and I think Bitcoin is unique. I'm a massive raging bull on Bitcoin. Um, very passionate about it. I know I might catch some hate from crypto Twitter by saying this, but the baby is going to get thrown out with the bathwater at some point, and I think we're seeing that to some degree. Even in crypto. So we've had some really interesting events happen in crypto, like Three Arrows Capital and Celsius, but and that's precipitated and created some of this downward price movement, and certainly helped this bear market continue on a little bit deeper than what we thought originally might happen. But contagion is a real thing, and real estate is kind of a staple of wealth in the United States. It's a staple of people's savings and of their life efforts. And so we really have to think about the different people that are investing in real estate or own real estate and how that affects their behavior in other asset classes. So let's start with the individual homeowner who has owned a home for 10 years, and their plan is to own it for another 10 years, and then hopefully it'll be paid off, and they'll sell it and they'll downsize, and that's going to be a big part of their retirement. If they watch the equity in their home deteriorate to a significant degree, maybe even approach the level of debt that they have on it right now, psychologically, that's going to impact them. They call that the wealth effect. And they're going to feel a lot less wealthy. And it's also a liquidity provider. Like their individual homes are liquidity for when they need it or if they need it, or a lot of times for discretionary spending. If someone wants to go buy a boat and the interest rate for boat financing is 8%, but they can take out a home equity line of credit at 3%, they'll go borrow the cheaper money against their house. And so the individual homeowner will absolutely be affected, and their both consumer decisions and their investment decisions are going to be affected. And you think if your home devalues by 25 or 35% and your equity, hundreds of thousands of dollars, perhaps millions of dollars, depending on where you are, gets evaporated, that's going to change your spending behavior and your investment philosophy. The last thing you're going to do is say, gee, I ran into an extra 10 grand, let's go put it in the stock market. So then you work your way up to real estate investors, and real estate investors get slaughtered with leverage in downturns. A lot of people don't realize you can own $100 million of real estate with 30 million of equity and 70 million of loans. But if the market corrects 30%, your net worth is zero. Mm-hmm. You've literally effectively been totally wiped out. And real estate is unique in that it's an asset, but it's also a liability. It's a liability if you have a mortgage, you have to pay property taxes, you have to pay insurance, you have to continue to maintain that real estate. And so when all of that, gets put on top of the shoulders of real estate investors, they not only sour on an asset class in general, but they get sour, on the economy and investing in general. The last thing they're thinking about is buying Microsoft stock or Apple stock, or if they've been crushed in real estate and they're struggling to make it and stay afloat, last thing that they want to do is go speculate on Bitcoin or Ethereum or Cardano or whatever the flavor may be. Then you look at institutions. Now, this is the interesting one, because institutions are pension plans and endowment funds or managed funds. Real estate is actually a very big alternative asset class to those institutions. And they're getting hammered right now. Like the traditional 60-40 portfolio is getting slaughtered. The stock markets and the portfolios are going down. The bond markets are going down. Real estate is certainly starting to turn over a little bit. Crypto has, certainly entered another crypto winter. There's really like no safe asset out there. Even gold and silver haven't performed like a lot of people expected them to. And so when everything is so bleak and you go to the biggest hard asset class in the United States of America, like hard asset as in, it's real, it's tangible, and you can have individual ownership of it, across the spectrum, we're going to see investors turn sour in general because real estate in specific has had a lot of value come off the market. And so I do think that Bitcoin will get wrapped up into that, even though in theory, guys like you and I absolutely believe that it should be this totally uncorrelated asset, that it should have nothing to do with the stock market, that it's the greatest hedge in the world against all this other stuff that's going on. And while we believe that that's true, the reality is that it remains very correlated. So to the core of your question, if we see real estate and see the bottom fall out maybe in 2 or 3 years in the midst of another halving cycle and potentially when Bitcoin should be doing really, really well, how does that affect Bitcoin? I think it's very difficult for Bitcoin to not be suppressed during that kind of an environment unless there's a black swan or a white swan that really drive home the value of Bitcoin to the masses inside that period of time.
To some degree, I mean, from sort of a selfish point of view, but to some degree, I would prefer for the real estate market to just rip the Band-Aid off rather than have a long, slow bleed. Just get it over with. So, because once you find the bottom, then you can just start trending back up again. Certainly, it would be nice if that would happen before the next halving, but we also know that these things with real estate, they take time to play out. And I mean, we're already halfway through 2022, and I guess in real estate terms, 2024 isn't really that far away. Right. You're talking about like 18 months from now. But we've covered a lot. I think this has been really useful to the audience. I will remind everyone, if you're not subscribed to Jordan, make sure you go subscribe to him. He just started his YouTube channel not that long ago. So certainly I think it'll be great if you go subscribe to him. He's got a lot of great content on there. He talks about crypto. I think he's going to be talking more about real estate as well. He's got a lot of experience in real estate, more than I have or really ever hope to have. But Jordan, I'll leave it. I'll leave it to you on sort of what the closing thoughts are. Like, what would you say to people? Just some final thoughts on the real estate market and how to navigate the next few years.
Well, thanks for that, Ben, and thanks for the plug for my YouTube channel. I just started literally about 2 months ago, and I've been talking about crypto because I'm very passionate about it. I love it. I watch your channel like crazy. I think you've called these markets better than anybody. I'm super impressed, and you've certainly saved me more than a shekel or two with your calls. But real estate really is my background, and I'm going to start creating a lot more content in and around real estate. What I would tell people is, number one, now is a time to be underweight real estate. This is not a time period where personally I feel like it's an opportunity to start buying in and taking advantage of 5 or 10% drops. I think that this is something a little bit bigger than that. And I think we need to give it time to play out. The other thing that I would tell people is, regardless of whether or not you own your own home or not, and putting that aside, it's a time to be excited, because if we look out into the years ahead, if you're thinking along the right lines and you're ready to take advantage of the opportunities, I think that there will be generational wealth created from buying this dip or this bear market in real estate at the right times and buying the right assets along the way. And so just pay attention to that and really focus on, maybe not day to day, it doesn't move like crypto does, but week to week and month to month, just follow it and be patient. And being patient is something really difficult to do for people like me, who like to do deals and like to do things and like to follow things that are very, very active. Real estate is not that active, but if you can manage that and be patient, I think that there's going to be some amazing opportunities ahead, and you don't want to miss those for sure.
Well, I appreciate all the wise words. And I think we'll go ahead and wrap it up there. So, one last reminder, go subscribe to Jordan if you're not already subscribed. And we will see you guys next time.